Well, let's get started with chapter 12, and we're going to start on page 553 and 554 of your book. And investments, debt, and securities. Basically, corporations investing in debt, bonds, or equity, stocks of other businesses. And so, why do businesses do that? To basically spend their cash. If a corporation has excess cash, you want to invest that, get a maximum return that you can for it. And so you'll do that by buying stocks and bonds of other companies. You can also influence other companies' operating decisions. The more shares of stock that you own, the more influence that you have, because now you have the right to vote for the board of directors. And so that will give you the ability to um, influence a company potentially. Sometimes it's cheaper for one company to buy another company to gain access to its assets rather than expend resources necessary to develop its own. So sometimes you just simply start to buy up another company because you want them. You want their people, you want their knowledge, you want their customers, you want their products, and sometimes that's just easier. I can think of many software companies doing that over the years. I've been involved with an SAP. If you've ever heard of SAP, it's a very large general ledger company based out of Germany, but they have a huge market share in the U.S. And when they see other products that are kind of like theirs, that kind of do the same thing coming from other companies, if they like them, they just go buy it. They'll just buy the whole company, take the programmers, absorb them into SAP, and integrate that particular facet of software information into SAP. So that's kind of that happens quite a bit. Companies just rather than try to develop their own thing, if somebody else is doing something that they like, they just go out and they buy it. So cash flow patterns, for a business can go up and down a lot during a fiscal year. Average cash needs is the green bar, and then the blue amount there is the actual cash on hand. And so we might start out with a cash surplus that we would then invest, and that excess cash can be put into short term, knowing that we'll need it soon. And then if we have not enough cash, we then would sell off our short-term investments and potentially borrow some more short-term to get us through it until our next surplus of cash that we have at the end of the year. So if you think of a manufacturer who's manufacturing something that's seasonal or cyclical, you're definitely going to run into these patterns if you're making lawnmowers or motorcycles or snowmobiles or snowblowers. You're definitely going to run into patterns like this where you're manufacturing a product and spending cash before you sell it and then have excess cash. And so you would use some short-term financing to help you get through those cash shortages. So securities, when they're bought, of course, we know the difference between debt and equity. Debt securities have interest and a promise of repayment of principal, a bond or a bank loan. Equity is stock, and that signifies ownership of a corporation. And we expect then potentially to receive a return on our investment in the form of dividends. So why companies invest into each other, and the cash flow pattern was on page 554 and 555. And then getting into more specifics of securities is on 556 and 557. A held to maturity security is a debt security purchased by an investor with the intent of holding it until it matures. So if I'm a corporation and I have excess cash and I'm buying securities, debt securities off of the market, and basically bonds, I would then classify it potentially as held to maturity, where I would then say I'm going to buy this bond and I'm going to intend to hold it until the bond matures. Of course, then while I hold it, I'm receiving interest payments, and when it matures, then I receive the principal back of the bond. Equity method securities, it says, method used to account for an investment in stock of another company when significant influence can be imposed. Okay. Presume to exist when 20 to 50% of outstanding voting stock is owned. So it's very possible to own 20% of another corporation and actually have enough stock to influence that corporation. It's very possible. That can happen quite easily. It's not unusual at all. And I just want you to be thinking about that when it comes to um, um, the equity method. Is we don't have to own more than 50% to control a company. 20% might do it, because you think of it this way: if nobody else has 20% of shares organized to vote for a board of directors unified, nobody else has control. So if we own 20% and nobody else is even close to that in terms of ownership, we do have some control. We have some influence on who sits on the board of directors, and then influences when it comes to corporate policies. Some other classifications are trading securities, debt and equity securities purchased with the intent of selling them in the short term if the need for cash arises, or to realize short-term gains. So it's a corporation again buying and selling debt and equity. So this is both stocks and bonds, buying them with the intent of selling them soon. Okay, it doesn't mean we have to sell them soon, but we're buying them thinking whenever we need that cash back, if we have a cash shortage, we'll sell off these investments to get that cash. Or if we think they're going to go up in value, we'll buy them and sell them to realize a gain. An available for sale security is both debt and equity, not classified as anything else. Okay, so it's not held to maturity, or it's not the equity method of a stock. Okay, so let me go back a screen and just remind you then, when it came to held to maturity, that was for bonds only, and equity is just for stocks. Okay, so held to maturity is bonds, equity is stocks, but trading and available for sale are both debt and equity. So I want you to be aware of that. Make a note of that. I'm pretty sure that's going to come up on a quiz and the test for this chapter. Okay, so there's different classifications of investments. Okay, so an investment can be debt or equity. That's first. And then underneath that, under equity, you can see the lines go to trading, available for sale, and the equity method. And then for debt, you can see the lines go to held to maturity, trading, or available for sale. Okay, so just keep that in mind. This might be a good picture just to kind of remember in your head when it comes to classifying these things. Okay, so because these classifications, how we account for changes in fair market value is different based on the classification, kind of where it gets reported, if it even gets reported at all. Okay, so trading, whenever there's and when we say disclose stat, we mean we're going to disclose on the balance sheet the fair value of our trading securities. So fair value means on the last day of the year, or the last day of the accounting period, any trading stock or bond will look it up on the market and just determine what is being traded for as of that day, and that's the value we'll record for that asset on that day. Okay, same thing with available for sale. Held to maturity, though, is only carried at amortized cost. So that is the cost of the asset plus or minus amortization of discount or premium over the years. Because remember, we buy a held to maturity bond with the intent of keeping it until it matures and we receive the principal back. Okay, so we don't record it at market value because we intend to hold it until it matures. The equity method, again, that applies just to stocks, and its cost, so what we spent to acquire the stock, adjusted for changes in net assets of the investee. Okay, we'll get into that, what that means later. Okay, so keep in mind then how these assets are disclosed in the balance sheet. And then the third column, one on the right here, is how do you report the fair market value changes of these assets? Okay, for trading, it goes to the income statement because we're not intending to hold them very long. We're buying them with the intent of selling them if we need the cash, or if they go up in value, taking the gain. Okay. Available for sale securities, if you remember back from chapter 11, we talked about other comprehensive income, and one of those was the change in market value of available for sale securities. The change in market value of AFS, available for sale securities, goes directly through equity. It does not go to the income statement. Okay, so we again recorded at market value, and that change in market value year over year goes to the stockholders' equity section of our balance sheet. Because held to maturities are recorded at amortized cost, there's no market value to recognize. And again, with equity method securities, they're recorded at cost with some adjustments, but only adjustments in relation to net assets of the company that we've bought, not to true market value. So there is no market value adjustment. So here's an example then of accounting for the purchase of securities. And I should kind of make sure you are aware of where this information is at in the book. And the different classifications, they kind of walk us through some of the different classifications and why we have those, which I've explained to you on page 558. But it's worth reading through that also. And they summarize that previous chart that I just got done looking at. This one right here. This is also on page 559 of your book. 559. Okay, and so then let's look at an example of purchasing, accounting for securities. Okay, so Picard Corporation purchased the following securities on January 1, and then record the appropriate entry is what they want us to do. And so they bought some debt, they bought some equity, they classified some of it as trading, and some of it as available for sale. And you can see the cost on the right, which includes fees. So whenever you buy or sell stocks, that includes a fee, and that fee just becomes a part of the cost of acquiring the asset. Okay, and so we can sum these up, and we're going to then make a separate entry for what's trading and a separate entry for what is available for sale. So we'll debit investment in trading, we'll debit investment available for sale, we'll credit cash for $35,800. And they give us an entry a lot like it on 561, but it just uses different dollar amounts. Okay, so now they're going to earn some returns on their investments. We're going to receive some interest and some dividends. And so we're going to receive cash, debit cash at $26.45, and credit interest revenue and dividend revenue appropriately, as you see here. We're then going to sell some securities. So when securities are sold, the difference between cost and selling price is what they call a realized gain or loss. The realized gain or loss is recorded in the income statement no matter what. Okay, so even if it's an available for sale or held to maturity, again, we can sell a held to maturity if we want to. We don't actually have to hold it. Some circumstance may come around where we decide we need to sell it. Okay, so whatever the security classification is, if we sell it, the gain or loss does run through the income statement. So here's an example of that right here. And they're going to start to show us some examples of selling on page 562. And so we're going to sell security 2 for $17,000. The cost was $15,500. Record the entry. Okay, so we're going to receive cash of $17,000. We'll credit investment in trading securities because it was a trading for $15,500, and then we credit realized gain for $1,500. If it was a loss, we would debit a loss account. Okay, how do we handle then changes in market values of securities? Page 564 will walk us through some examples of that. Changes to the market values of trading and available for sale securities should be recorded every reporting period, if it's monthly, quarterly, annually, whatever it is. And it says unrealized gains and losses are recorded. The opposite side of the entry is to a market adjustment account. Okay, so we'll debit unrealized loss, or we'll credit unrealized gain, and the flip side of the entry then goes to a market value adjustment account. The third entry says the market adjustment accounts are combined with the securities accounts on the balance sheet, effectively reporting the market value on the balance sheet. So we take cost plus these market value adjustment accounts. The combination of the two then results in the balance sheet reflecting market value appropriately. Okay. For trading securities, unrealized gains and losses go to the income statement. Okay. Unrealized goes to the income statement. For available for sale, we've already mentioned that unrealized gains and losses are a component of equity, and we call that other comprehensive income. Realized gains are always reported in the income statement, no matter what. Okay, so it's the unrealized that's either income statement or balance sheet, depending on if it's trading or available for sale. Realized, no matter what, goes directly to the income statement. Here's an example, and again they've got some examples here on page 564. The following market values are recorded for Picard Corp's portfolio on December 31, 2009. Record the changes in the values of these securities. Okay, so you've got trading, you've got available, and two available for sales. The market values you can see for security 1, it has an unrealized loss. For the others, we have unrealized gains for securities 3 and 4. So for our trading security, we have a loss of $200, a difference between $3,000 cost and $2,800 market value. And so we debit unrealized loss on trading, and we credit the market value adjustment trading securities. Okay, so that unrealized loss then will show up on our income statement. For the available for sale securities, the market value adjustment is $2,450, and it's a gain. So we're going to debit market value adjustment, which then makes our value of our assets go up by $2,450, and we'll credit unrealized increase in value of available for sale securities, which makes our equity go up. That's a component of equity, that other comprehensive income that we talked about in chapter 11. And so equity goes up and assets go up because we have this unrealized gain. How about the next year? That was for 2009. Okay, 2009. What happens then in 2010 if the market values change again, which they will? And you can see here that for trading, we now have a market value of $3,100. If you can remember, it was $2,800. Now it's $3,100, so it's gone up by $300 in the year. Okay, and so the market adjustment trading securities then is a debit of $300, and we're going to credit unrealized gain of $300. Okay, because we had a loss of $200, and we now have a gain of $300 from that. So the market value has gone up by $300 since the last reporting date. Okay, and again, that unrealized gain then will go to the income statement. The balance sheet will show that our trading securities will go up in value because of the market adjustment by $300. How about the available for sale securities? And I should tell you that the subsequent changes, they're showing us these adjustments on 566. And so here's the example of initial purchase of a held-to-maturity securities. So for held-to-maturity, it says that Picard Company purchases a 5-year, $500,000 bond and receives interest of 10% payable semi-annually. Okay, again, that means twice per year. Assume the effective rate of interest on this security is 12%. So the semi-annual interest payments are $25,000. The present value is $184,002. The principal is $500,000, and the present value is $279,197. And so the present value then is that $463,199. And again, they didn't make us calculate this, and that's what you'll find when you do the homework is they're just going to give you these numbers, and we'll debit investment in held to maturity for $463,199. we'll credit cash for $463,199. And we're gonna record that only at cost. Okay, so in this example here, we have bonds purchased between interest dates. So what happens when we buy bonds between interest dates? It says assume that bonds purchased by Picard Company, and that's on page 569, by the way, on July 1 and January 1 of each. They pay interest on July 1 and January 1. What if we buy the bonds on April 31? How will the purchase be recorded? Okay, and so we're going to debit our investment held to maturity of $463,199, and we're going to debit bond interest receivable of $16,667, and we're going to credit cash for $479,866 because we're basically buying interest. Okay, because the last interest date was January 1, so January, February, March, and April have all happened now, 4 months. Okay, and so interest accrues through the passage of time. And so when we buy that bond on April 31st, we're buying the bond plus interest between January 1 to April 31. And then on the next interest date of July 1, we'll receive that money back. Okay, so we're basically buying interest, and then we'll receive it with the next interest payment from the bond issuer. Sale of maturity of bonds. What journal entry is required if Picard if they sell the bond for $9,900 before maturity, when the balance of the account would be $9,800? Then we just simply have a gain. We debit cash for $9,900. We credit gain for the difference, and we credit our investment for $9,800. So again, we can sell a held to maturity bond before it matures. We don't have to hold it. Nothing says we have to hold it. We can still choose to sell it. Previously, when we talked in Chapter 11 about bonds, we talked about both the straight line and the effective interest methods of amortization of discount or premium. And we know that with straight line, you basically come up with a number and you use that same number every single time you pay interest. The effective method then just means that we're going to allocate a different amount for interest versus principal with every payment. So here's a straight line example, and the straight line example they're going to show us on page 570, and Picard purchases a 12% 5-year $10,000 bond, spends $8,658 for that bond on the issue date. The interest payments are made semi-annually, again twice per year. Using straight line, record the first interest payment received. Okay, and so a 5-year 12% bond. Okay, so it's basically, think of it as that 12%. Just think of it as 6% per payment. Okay, so 0.06 times 10,000 is 600, and so that's the cash we're going to receive for 600. And then the interest revenue is they're not giving us really the numbers to calculate that, but then we have to just know that the interest revenue is $734.20, and then we have a typo here in the debit to investment into held to maturity securities. It's not $1,134.20, it's $134.20. Forget the thousand and the comma there. It's $134.20. The effective method then is we just have to use an amortization table, which I've shown you how to use that back in Chapter 11. I gave you a table that will do that. They show us the table for this particular problem, or one just like it, is on page 572. And the journal entry is the same, just the dollar amounts change. We still debit cash for 600, but how much goes to interest revenue, and the debit to investment into held to mature securities changes. Okay, so again, this is bond accounting from the perspective of we own the bond, we're the bondholder, whereas back in Chapter 11 we did the bond accounting from the perspective of we were the bond issuers. Okay, so it's a little bit different in terms of we're debiting cash and we're crediting revenue, whereas before it was the other way around where we were debiting interest expense and crediting cash. Okay, so just keep in mind these entries in this chapter are the perspective of being the bond holders. Okay. Accounting for the equity method of securities. And the equity method of securities is on page 575 and a little bit on 576. Okay, so 575 and 576. When the percent of outstanding voting common stock, so this applies just to common stock, is sufficient to exercise influence, they say that between 20 to 50% is normally enough to get influence. Obviously, if we own 51%, there's no doubt that we have influence because we have the majority shares, but it's very possible to have influence with under 50%. Okay, so with the equity method, the book value of the investment increases with earnings being reported by the company. So if the company we own reports earnings, that means the book value of our stock goes up. The book value of the investment decreases whenever that company we own either has net loss or pays dividends. Okay, the amount of earnings or loss that we record is completely in accordance with the percent of ownership that we have of that stock. If it's 10%, or I should say 20%, 30%, 40%, whatever that number is, that will affect the journal entry. So we have to be very mindful of what percent of ownership that we have in the company. In this example, it says Brown purchases 100 shares of Monarch at $2 per share. That's 20% ownership of Monarch. Okay, record Brown's transaction. And we're saying because we hit that 20% threshold, we're going to call that then an equity method. So we're going to debit investment in equity method securities and credit cash for 200. Okay, and then Monarch will pay a dividend of 80 cents per share. And we own 100 shares, so 0.8 times 100 then is the amount of dividends that Monarch is paying. Only notice, of course, we debit cash. We're going to get a check for $80, but we don't credit revenue. Okay, that's the key difference here. Instead, we credit the investment account. So we debited the investment account when we bought the company, but when we receive dividends from them, that reduces our equity. So our ownership goes down. So we now credit the investment for the $80, the amount of the dividends. Monarch reports $10,000 worth of earnings. Okay, we own 20% of the company, and so therefore 20% of 10,000 is 2,000, and so we effectively own $2,000 worth of their earnings. So we're going to increase the value of our equity. We're going to debit the investment in equity account, and now we can call it revenue. And now we're going to credit revenue from investments. Next is the concept of consolidated financial statements. Consolidated financial statements are used when an investor is able to exercise control, typically more than 50%. Okay? The objective is to report one set of financial statements that's the result of all the companies owned or controlled by one parent company. Okay, and so you'll see an example of that on page 578. So we have a parent company that owns 3 subsidiaries. It owns one of them at 100%, the other at 80%, the other at 30%. And because of the control influenced, it really makes more sense to report the combined or the combination of all these companies together rather than each of them individually. Now, of course, we have something called minority interest, which reflects minority or ownership interest that does not belong to the parent. Okay, so that's minority interest. So here's an example of a consolidation. It's basically taking the balance sheet, the income statement, statement of equity, and then combining the parent with the subs. And so they show us this like this, and they'll turn that into a consolidated number. And so we have this investment in subs here, and you can see that because investment in sub 3, it's only 30%. It's an equity method investment. We don't control them. They get their own line. Whereas the other entities, because we have 100% and 80%, we do control them, so we're consolidating those subs. Subs 1 and 2 are consolidated with the parent, but sub 3 is an equity method stock because we don't own more than 50%. Okay, so like cash is 88 on the combination. That 88 is 48 plus 20 plus 20. I didn't include this. I only included the fact that I own 30% of the $120,000 worth of equity in that company. Okay, right here. So it's kind of the format that you follow when you do that. And then same with the minority interest down here. Sub 2, remember I only owned 80% of sub 2 right here. It has equity of 120. So I own 80% of that company. Somebody else owns the 20%. So I have to show a liability for 20% of that 120, which is minority interest here of 24,000. The equity then, this 400,000 of equity right here, okay, that's the equity that I show in the consolidation right here. It's just that equity. Only the parent's equity makes it into the consolidation. Then with income, you can see here I've got revenues, I've got income from subs, I've got expenses and net income. And then we can see how we combine that. And then the consolidated income statement's right here. For revenues, it's 4790 plus the 2 plus the 2. I don't include this one because it's an equity method subsidiary. And then I've got revenue though from that company. I've got the 30% of the $100 net income. So I've got that revenue right here. And then my expenses are 6,800, which is the 3,000 and the 19 and the 19. I've got minority interest income, which is 20% of 100 net income of sub 2. And my net income then is simply the same net income that my parent company had. And that's it.